7 undervalued investment opportunities the masses continue pursuing trending equities, the headline makers. The dinner conversation topics. Here's an uncomfortable truth nobody acknowledges. Most investors purchase at precisely the wrong moment. They're overpaying for compelling narratives, then questioning why their performance remains mediocre. What if there's an alternative approach? One where you abandon crowd mentality and embrace data-driven decisions? Today, I'm revealing 7 investments generating zero social media buzz, yet their fundamentals signal tremendous opportunity. These aren't rapid wealth schemes, they're enterprises capable of revolutionizing your portfolio across the next 5 to 10 years if you comprehend what you're actually acquiring. Before diving into specifics, help me out. If you're committed to building genuine wealth through intelligent investing, subscribe immediately. Finance Hype focuses on eliminating distractions and concentrating on what genuinely matters for growing your capital. We're not trend chasers, we're wealth builders, methodical, intelligent, and significantly less stressed than typical investors. Why most investors approach this market wrong. You've undoubtedly heard about the Magnificent Seven, those tech behemoths carrying markets for years. They're exceptional corporations, unquestionably. However, here's what investors overlook. When universal love exists, when everyone's purchasing, when narratives seem risk-free, that's typically when mathematics turns unfavorable. Superior companies at incorrect prices remain poor investments. Let me repeat this critical point. Superior companies at incorrect prices remain poor investments. You might acquire the world's finest business, but overpaying guarantees disappointing returns. This is where people fail, falling for narratives while ignoring valuations. So what's my different approach? I saw companies experiencing the opposite scenario. Situations where narratives have quieted, where investors have chased shinier alternatives, yet underlying businesses continue executing perfectly, generating profits, growing consistently, and trading at sensible valuations. These situations create fortunes for patient investors, not through superior intelligence, but through willingness to examine overlooked opportunities. Stock number 1, beauty retail giant. Let me begin with a beauty industry player. I know your thoughts: beauty products during economic uncertainty. History reveals that even during financial constraints, people maintain personal care. Beauty spending demonstrates remarkable resilience. This specific retailer has constructed an empire with over 44 million loyalty members. Consider that figure momentarily: 44 million repeat customers who trust this brand and integrate it into their routines. That's not merely a customer base, that's a competitive advantage. They're expanding beyond product sales, growing salon services and skincare consultations offerings with substantially higher profit margins than simply selling shampoo bottles. Additionally, they're partnering with major retailers to access customers at existing shopping destinations. The business model is solid, growth is steady, and here's the interesting part. Shares surged over 40% this year. Before concluding you've missed the opportunity, understand something important. A 40% stock increase doesn't indicate 40% business improvement. It reflects increased investor excitement. When excitement builds, prices often exceed fundamentals, creating opportunities for patient investors. When this stock retreats, and it will, because all stocks do, that's your attention moment. Stock number 2, the profitable airline. Let's discuss airlines. I already hear groaning. Airlines are challenging businesses. Warren Buffett has discussed this industry's brutality. However, here's the fascinating aspect. One airline achieved something nearly impossible: 47 consecutive profitable years before the pandemic. 47 years. While competitors declared bankruptcy, this company consistently generated profits. Then COVID arrived and they struggled like everyone else. But markets forget something. Problems were temporary. The business model, succeeding for 47 years, didn't suddenly become obsolete. They faced outdated computer systems and operational challenges, but they're resolving them. Profit margins are recovering. Last quarter significantly exceeded expectations. Analysts project earnings could quintuple over coming years. Even achieving halfway there suggests serious upside from current valuations. When quality businesses encounter temporary turbulence, that's not avoidance justification, that's precisely when to examine closer. If you're finding this breakdown valuable, comment below indicating which stock interests you most or mention stocks you're monitoring. I read every comment, and honestly, the best discussions emerge in comment sections. This community makes finance hype special. Stock number 3, the crushed payment processor. Now, let's discuss a payment company that's been absolutely demolished, down 74% over 5 years. Here's the fascinating part. Revenue during that identical period increased over 250%. Absorb that. The business expanded massively while shares were destroyed. How? Simple. 5 years ago, investors paid ridiculous prices, paying for perfection, endless growth, narratives seeming too good to be true. When reality arrived, when growth decelerated to merely good instead of spectacular, shares collapsed. But now you've got a situation where this corporation generates billions in free cash flow, dominates digital payments, grows through multiple channels, and trades at valuations unseen in years. They're aggressively repurchasing shares at these depressed prices, exactly what you want management doing. When companies buy back stock at 10 times free cash flow, they're essentially securing 10% returns on that capital before any growth. That's powerful. This is a cash-generating machine Wall Street abandoned. That disconnect between price and value is where fortunes materialize. Stock number 4, Chinese e-commerce powerhouse. Here's another surprising one, a Chinese e-commerce titan everyone dismissed. Regulatory fears, economic concerns, geopolitical tensions all pushed shares to absurd levels. I purchased around $60 and watched it climb to nearly $200. I lost shares to covered call assignments, which hurt at the time. But here's the lesson. Sometimes profit-taking is correct even when uncomfortable. That stock has now significantly retreated, and guess what? The business keeps improving, investing heavily in artificial intelligence, streamlining operations, focusing on shareholder returns. China creates more millionaires and billionaires faster than anywhere globally. When wealth grows that rapidly, who benefits? Companies serving those consumers. Temporary political noise doesn't alter long-term wealth creation trajectory in that market. I'm not suggesting immediate purchases, I'm saying monitor it. Understand fundamentals and establish a price where risk-reward makes sense for you. Make sure you're hitting that like button if this analysis is shifting your investment perspective. It helps the channel reach more people serious about building wealth correctly. Stock number 5, the forgotten software giant. Let's discuss a software company everyone seemingly forgot. They dominate creative software. If you've edited photos, designed graphics, or created videos, you've probably used their tools or witnessed their influence. This company possesses something magical: recurring revenue. Customers don't purchase software once anymore. They subscribe monthly, meaning predictable, steady income for the business. They maintain 90% gross margins, almost unheard of. That means for every revenue dollar, 90 cents flows to bottom line before operating expenses. They're not pursuing every trend, they're strengthening what they already excel at. Shares peaked at $700 several years ago, now trading around half that. Did the business deteriorate 50%? Absolutely not. Revenue grows steadily, margins expand, and they're repurchasing shares. This perfectly exemplifies price-value disconnection. The narrative quieted, investors departed, and patient value investors enter. Stock number 6, global athletic brand. Athletic wear and footwear. Let's discuss a global brand encountering obstacles. They're managing inventory issues, margin pressure, tariff concerns, and shifting consumer preferences. Wall Street despises uncertainty, so shares have been punished. But ask yourself, 20 years from now, will this brand still exist? 30 years from now, will people still wear their products? Unless something catastrophic occurs to consumer culture itself, the answer is almost certainly yes. They've appointed a new CEO mid-turnaround. They're eliminating excess inventory, which temporarily hurts margins but establishes healthier profitability once completed. They're investing in innovation and digital engagement. Shares are significantly down from peaks, meaning expectations are low. When expectations are low and businesses start executing, that's when stocks make substantial moves. This isn't about hoping for miracles, this is recognizing that temporary problems in strong brands create opportunities for patient capital. If you haven't already, comment with your thoughts. Are you purchasing any of these? Disagree with my analysis? Let's start a conversation because that's how we all become smarter investors. Stock number 7. Specialty organic grocer. Finally, let me discuss a specialty grocer emphasizing healthy organic foods. I originally purchased this stock in the low $30s. It ran to $170 and I got shares called away through covered calls. Initially, I felt I missed something huge, but then I reminded myself of something crucial. Just because stocks rise doesn't mean they're worth more. The business hadn't fundamentally changed much. Investors just got extremely excited extremely fast. Now that stock has retreated, and guess what? Fundamentals have actually improved. Their margins are expanding because they're adding more private label products with substantially higher profit margins. They're growing store count steadily. They're operating in a market segment, health-conscious consumers, growing faster than traditional grocery. The business executes, but shares surrendered most gains. That's not problematic. That's another opportunity to evaluate whether price makes sense relative to value. What ties these 7 together? Here's what connects all 7 stocks. They're not the loudest market names. They're not dominating financial media headlines. They're not break room conversation topics. But every single one shares something common. They are businesses with solid fundamentals, trading at prices creating potential for meaningful long-term returns. Notice I said potential, not guarantees. No investing guarantees exist. But when you purchase quality businesses at reasonable prices, you're stacking odds favorably. You're not relying on hope or hype, you're relying on mathematics, cash flow, the reality of what these businesses generate annually. This distinguishes investing from speculating. Speculation is purchasing something believing someone else will pay more later. Investing is purchasing business pieces because you understand their worth and you're paying less. One approach relies on timing and luck. The other approach relies on patience and discipline. I know which one I'm betting on for the next decade. What you should do next: markets will do what they always do, swing wildly, punish good companies for temporary problems. Reward mediocre companies for exciting narratives. Your job as an investor isn't predicting those swings. Your job is understanding value, recognizing when price and value disconnect, and having courage to act when others flee. That's how wealth builds, not quickly, not flashily, but steadily, methodically, with far less drama than most people experience. So what should you do with this information? First, conduct your own research. Don't accept my word or anyone else's as gospel. Understand what you're purchasing. Examine financial statements. Understand business models. Know what you're paying and what you're receiving for that price. Second, think long-term. If you're unwilling to hold something at least 5 years, don't buy it. Short-term trading is a different game with different rules, and most people lose at that game. Third, be patient. The best opportunities don't announce themselves with fireworks. They arrive quietly when everyone else looks elsewhere. Fourth, manage your risk. Never put everything into one stock or idea. Diversification isn't owning 100 things. It's owning enough good businesses that one mistake won't sink you. Finally, stay disciplined. When your stocks rise, don't assume you're a genius. When they decline, don't assume the world is ending. Stay focused on fundamentals, on whether businesses are performing as expected, and let time work favorably. Before you go, make sure you're subscribed to Finance Hype. Hit that bell icon so you don't miss future videos. We're tracking these stocks throughout the year, updating you on performance, and sharing new opportunities as they emerge. Drop a comment, smash that like button, and share this video with someone serious about building wealth. The more people we can help think intelligently about investing, the better off we all are. Thanks for watching, and I'll see you in the next one.